Look at Qualcomm, Paul. This is a American multinational corporation in San Diego and Delaware. We're in Delaware. Intellectual property, semiconductors,
Hi.
software,
I'm in Delaware.
and services related to wireless technology.
Does anybody know where that's from?
No.
Hi.
You don't, Mo?
Or you can be magically whisked away to Delaware. Hi, I'm in Delaware. Don, you know what that's from?
I've heard it. I honestly.
Let's see if anybody knows
I've never
it.
even heard it.
They're all too young. I can't believe I'm
Somebody can
saying
just
that
Google
now.
it.
I know.
Wayne's World. There you
Wayne's
go,
World.
Don.
Don,
Thank you
you're the
very
winner.
much. Danny, Wayne's World.
Great.
Wayne's World.
Paul will be sending
Wayne's
you
World.
a cash
$1 million.
reward. Yep, go ahead, Paul. This is
$150 billion market cap.
great. This is Qualcomm.
PE of 22. I want to make note that Qualcomm was selling, I mean, look at this, 70 a year ago. Look at this profit margin, though, 25%. That's incredible. That's a good profit margin. Chickadee check. Even though we're probably removing the profit margin from there, I still like seeing these big profit margin numbers because I look at the chip industry. These are high margins with a higher barrier to entry. Same as Microsoft, same as Apple, same as Google. I mean, yes, you can create software anytime, but the amount of money it would take to get people to fully switch over is so difficult that I like these margins on higher barrier to entry. This is what Warren Buffett would call a moat of some sort. I'm not saying this is a moat, but he looks for good margins that have higher barrier to entry in the sense of to get people to do a full switch over. Now, I haven't done any research on how hard it is to switch away from Qualcomm. This isn't a consumer business, it's a business to business. But like companies are using Qualcomm chips for their products, correct?
Yes.
Excellent. Okay, free cash flow, 6.3 billion. Dividend yield of almost 2%, and they're eating up about half the free cash flow, a little bit under half. So, okay, by the way, look at this. Return on assets, 19.6. That's a big number when it comes to the little book that beats the market.
Return on assets?
Yeah, I look at return on invested capital, which we're going to be adding here shortly, and that might be the new metric. But it shows how they're making money on their assets. Return on invested capital talks about how they're able to reinvest money at a higher rate.
Yeah, news to me. Paul is going to be changing two of the pillars out, which I'm already confused at the 8 we have. So as we move forward, we'll be confusing me even more. So let's go to revenue growth, pillar number 3. While Paul texts his girlfriend, get back on the show here, Paul.
By the way, she did message me that she is watching the thing right now.
How nice.
And by the way,
Paula.
please sign up for the Patreon. This is like we're going to keep doing this. This is the software. You'll get it. It's so funny.
You almost just kind of get fed up with yourself when you talk about the Patreon. You're like, all right, just this is
Well,
ridiculous.
I just don't get why people even have to think, like, oh, should I do it? Should I do it? Like, this is crazy. Like, if you take anything having to do with money seriously, you should sign up for it.
I guess you're right. Go ahead, Paul. This is-
23.8 billion to 26.7 billion. So that's a check mark there. And it's a mature company. That's why you don't see a lot of growth. I mean, look at 2012. They did $20 billion. And they had a big jump. They probably made an acquisition. So either way.
That's a check for revenue. And Paul, you love maturity, mature women. Pillar number 4 is profit growth over the past 5 years.
4.9, 6.7. Look at this. They had a big negative the second year. I guarantee it's a write-off of some sort.
Okay, that is, wow, we got 3 out of 4. Now, the PE was only 22, so we're almost at 4 straight checks. Pillar number 5 is shares outstanding. We want this going down, Paul.
It is going down. Again, this number is not accurate. We're still working on their data feed with Morningstar. I love Morningstar, but they're the worst at responding to emails. So this is not an accurate number. It's actually 1.5 billion. It's divided by 4. So 1.5 down to 1.12 or something like that. So it is a check mark there.
Okay, you want to do free current assets over current liabilities?
Well, I mean, that's the next one, so we probably should do it.
For now.
20 billion.
Oh my gosh, Goldie says, how many pillars does Paola have, your girlfriend? Good Lord. A lot
good
of
question.
pillars, yeah.
She's got good pillars. Mm-hmm. Wait, what are we talking about? 20 billion versus 9 billion. They have plenty of cash. And the great thing is their liability is only 30 billion on that 20 billion. Now, one of the things that you have to do, the reason somebody once asked me, why don't we look at your debt to equity? Because it varies from industry to industry. That's where profit margin, I think I look at like, okay, is there a lot of debt with a low profit margin? That concerns me all the time, but the debt to equity is something you should look at, but I don't have it as a pillar.
Pillar number 7, Paul, you love this one, which is free cash flow growth. Again, folks, we're looking at Qualcomm, ticker symbol QCOM.
5.9 billion, 6.3, check mark there. Seth, please tell me you have your calculator out.
Yeah, 6.3, keep going.
4.4, 1.8, 7.
7 divided by 5. The average free cash flow over the past 5 years is $5 billion, Paul? $5
Yep.
billion. $5
The thing I like
billion.
about this, guys, is they had a really big drop in 2018. So I like the fact that we're factoring in a big drop. And even though the previous years were, boom, whatever. So 5 billion times 20, which I think is a high multiple, but we'll get into that, $100 billion.
You think the multiple should be lower for this company?
There's arguments to be made about why we keep it at 20. One, big random year of 1.8, big drop. In previous years, very consistent. So consistency can also make you want to pay a higher multiple. Pay a higher multiple for growth, consistency. There's all these factors. You can justify a higher multiple for anything, but it's about how this is the art of investing. Where do you feel this multiple should be? I feel for a company like Qualcomm, I think I feel comfortable paying $100 billion for this company with this big anomaly of a year with a big drop in free cash flow. The company is currently 200 and what billion?
150 billion is the market cap.
150?
Dark Knight is saying in 2018 they got blasted with taxes or something.
We can check that out. That may be true. 150, guys, this is close. Under $100 a share, I'm buying this thing.
Come on.
Yeah. In fact,
Go on.
maybe at a higher price because they're buying their shares back aggressively. So remember, when they're buying their shares back aggressively and they have a high return on assets, this is pretty good.
Puts, baby.
What are you
Yeah, I
saying,
think we
Mo?
gotta look at
I mean, it's $132 right now.
Oh, so I thought it was $150. I'm sorry. So, but still,
Yeah,
a
but
third
that's
is
even
still
better for us.
Mo, you do your thing. I'll
Pull
put
up
the
an options
puts.
chain. Okay, so, whoops, I should probably erase that, huh? So this is a perfect example of what a dog stock is. Somebody mentioned power stock. That's not right. You need to go back and watch the Trading 101 series.
Well, for Seth, tell Seth what a dog stock is. It sounds funny when you say it.
I'm going to tell you right now. So if you look here, this stock, it went through the sweet spot, it went down, and it got to the bottom of its trend line, and it just keeps going sideways, 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 and the price just keeps coming down, down, down. Eventually, that's going to stop. Eventually, big institutions are going to come and start pouring money into the stock. They're clearly not doing that right now. So the big hedge funds and all your money managers and this and that. When they do that, this trend is going to turn up on you. This red line is I should just use red. This red line is going to turn up on you and go positive. This is the perfect reason, and the reason that I started saying that you need to buy a tracker share because of stocks like this. Because you can just buy one share at $132 and just wait and wait and wait. And when this thing does turn up, you will be able to catch it right when it crosses that 32% line and starts making green engulfing candlesticks. Perfect dog stock. Go buy a tracker share. Everyone should do this one.
And the options here suck.
Damn.
Why is that?
I knew they would. I mean, you're getting no return. Let's say I want to buy it at $100. So when I'm selling a put, I'm picking a date in the future. In this situation, April 16th, and I'm picking a price, $100. I'm going to get paid around 30 cents per share. So 30 cents on $100 is 0.3% I'm going to make in the next 37 days. So basically, I'm getting a 3% return per year because 37 days is 1/10 of the year. So I'm looking at going, hey, it's better than having cash sitting around. And I do like the Qualcomm stock. So maybe I just do it just for yield. And I go, okay, I'm fine with that. But that's what we're looking at here for Qualcomm. You can go out in the future further. You might be able to pick a date in the future, like, let's pick.
Go 3 months out.
What's 3 months? March, June?
June
At $100 a share is $1.58 was the last trade.
Okay.
So now you're looking at how much of the year? 100 days, so 3.6. So $1.60 is 1.6% times 3.65. Actually, that's not bad. What is that return?
Is it $100?
$100. The last trade was $1.58. So here, guys, if you go out further, 100 days, the last person got $1.58. The current midpoint is $1.34.
6%?
I mean, that's about 6% right there.
That's not bad.
That's not terrible, but when you go out further, the risk you take is something changes in the meantime.
Right.
So I haven't done any research on Qualcomm. This is definitely one we need to go read the 10K for. Because we don't understand, are they losing business on anything? Is there any major part of the business that's falling? Remember, usually when stocks are a good deal in a booming market, there's a good reason for it. Not being overlooked is not one of them. So let's pay attention to that.
This is a stock to go do due diligence on.
Yes.
Remember, this is the screening out process. We just screen for it. we found something. Now we're gonna go do the due diligence.
Thanks so much for watching the video. We hope you were intrigued. If this style of investing speaks to you, click the link below to join our Patreon. As a patron, you get access to a wonderful community of like-minded investors where you can chat, connect, ask questions, and share ideas with badasses like you all over the world. The best part is you get the amazing Everything Money software. This is revolutionary, unlike any YouTube page. You can track your investments, look at stocks, and quickly run our 8-pillar analysis on any company you like. The top tier patrons get direct access to Paul and Trader Mo. You'll see their daily trades, their updated portfolios, and every options contract they write on a daily basis. We provide Patreon exclusive videos just for you, including live streams and exclusive content from our team. Our bottom patron tiers fill fast, so join today. But hey, if you don't believe me, look at all of our patrons' amazing success stories. In comparison to other financial platforms, our software is by far the best value. This is your chance to get serious about investing. If you're finally ready to level up your investing game, join our Patreon and let's start kicking ass together.